Ever feel like your paycheck disappears before you even get a chance to enjoy it? And when it comes to thinking about retirement, it seems like you need a fortune just to live comfortably. But here's the thing. You don't need millions in investment to surpass your current job. Today, I'm going to show you how investing $120 a week into SCHD could not only solve your paycheck struggles, but also set you up for retirement. I'll explain how it can snowball into a portfolio value of over $2 million. And in the end, I'll show you how $120 a week can help you achieve annual dividend earnings of over $180,000, which translates to a monthly income of over $15,000. First things first, what exactly is SCHD? Schwab U.S. Dividend Equity ETF, or SCHD, was launched in 2011, and since then, it has become one of the most popular dividend-focused ETFs available. With a focus on U.S. companies that have a strong history of paying dividends, SCHD combines the stability of large, well-established companies with the potential for long-term capital gains. This ETF is designed to track the Dow Jones U.S. Dividend 100 Index, which selects its holdings based on strict criteria. SCHD is all about combining consistent dividend income with the potential for capital appreciation. It's structured to invest in companies with a strong history of paying and growing their dividends, which makes it appealing for both income investors and those looking to grow their wealth over the long term. What makes the ETF unique is its balanced approach to dividend investing. Rather than focusing solely on high dividend yields, which can sometimes come with higher risk, it emphasizes quality. The fund includes companies that are not only paying dividends, but are also financially healthy and have a strong track record of increasing dividends over time. This focus on quality ensures that investors are not exposed to the riskier high-yield dividend stocks that might cut dividends during difficult times. You might be wondering, how does SCHD decide which companies to include? Well, it all comes down to a very deliberate selection process based on a specific set of criteria. SCHD follows the Dow Jones U.S. Dividend 100 Index, which ranks companies based on their financial health, dividend yield, and dividend growth. To be included in the index, companies must meet 3 requirements. First, companies must have a history of paying dividends for at least 10 consecutive years. This makes sure that only companies with a strong commitment to returning capital to shareholders are included. Secondly, dividend growth. Beyond just paying dividends, companies must also show a history of growing their dividends over time. This is crucial because it shows that the companies are not only able to pay dividends, but are also increasing those payments as their businesses grow. Lastly, their financial strength. Companies are evaluated based on financial metrics such as return on equity and free cash flow, ensuring that only financially strong companies are included in the fund. When you invest in SCHD, you're investing in a diversified portfolio of 100 high-quality U.S. companies across various sectors. The holdings are spread across industries like financials, healthcare, consumer staples, and technology. This diversification is key because it reduces your exposure to any single sector, providing a cushion against downturns in specific industries. Some of the top holdings include well-known companies like the Home Depot, BlackRock, Cisco Systems, Lockheed Martin Corporation, Pfizer, Verizon Communications, and Texas Instruments. These are large, established companies with a strong track record of paying and growing dividends. For example, the Home Depot is one of the largest home improvement retailers in the world, and it has 32 years of history increasing their dividends. Pfizer, a leading pharmaceutical company, is another notable holding that provides a stable source of income for investors. Texas Instruments, known for its leadership in semiconductor technology, is also a top holding, offering both growth potential and reliable dividends. SCHD's holdings are carefully selected to balance stability and growth. By investing in companies across various sectors, the fund minimizes risk while providing exposure to companies with strong dividend growth possibilities. Speaking of growth, let's see where SCHD has been performance-wise. One of the most compelling reasons to invest in SCHD is its strong historical performance. Since its inception in 2011, the ETF has consistently delivered solid returns, both in capital appreciation and dividend income. Let's compare it with a broader index like the S&P 500 if you're wondering how it stacks up in terms of performance and income potential. Over the past 10 years, SCHD has provided a price return of over 120%. While this may not be as high as the S&P 500, which returned around 200% over the same period, SCHD offers the added benefit of a higher dividend yield. This makes it particularly attractive for income investors who are looking for a steady stream of income while also growing their capital. SCHD's dividend growth has been equally impressive. The fund's dividend yield currently stands at around 3.41%, and its 5-year dividend growth rate, or CAGR, is 12%. This means that not only are you receiving a healthy dividend yield, but those dividends are also growing at a significant rate over time. In terms of overall performance, SCHD has proven itself to be a reliable choice for long-term investors. While it may not offer the same level of capital appreciation as the S&P 500, its combination of dividend income and growth potential makes it a solid option for those looking to build wealth steadily. But does it have what it takes to hit a 6-figure valuation? That's what we'll see in the end. And also, I'll show you how it can turn a $120 per week investment into a portfolio that pays over $180,000 in annual dividends. One of the key factors contributing to SCHD's strong performance is its focus on high-quality dividend-paying companies. These companies tend to be more stable and financially healthy, which helps protect against downside risk during market volatility. This brings us to the risk profile of the ETF. SCHD has a relatively low expense ratio of 0.06%, which helps enhance overall market returns by reducing costs. Moreover, its volatility, measured by the beta, is lower than that of the broader market. This means SCHD tends to experience smaller price swings compared to the overall market, making it a less risky investment option. SCHD is currently priced at $28.55 per share. And don't be afraid, the stock price didn't plummet. They recently executed a 3-for-1 stock split, which took effect this October. The split resulted in the price per share adjusting to approximately $28.34 from a pre-split price of around $85.02. However, it's important to note that such a split doesn't alter the total value of investors' holdings, but rather increases the number of shares each investor holds, making the shares appear more affordable without changing the fundamental value of the investment. The ETF has a price-to-earnings ratio of 5.42 and a PB ratio of 2.85, which is relatively good compared to the broader market, suggesting that it's not overpriced. Its focus on fundamentally strong companies like Home Depot, Cisco Systems, AbbVie, Amgen, and Chevron underpins its stability amidst market volatility. Now let's get into the exciting part. How can investing just $120 a week into SCHD eventually surpass your full-time job income? The key here is consistency and the power of compounding. By investing $120 a week into SCHD, you're not only taking advantage of capital appreciation, but also building a growing stream of dividend income. As the companies in SCHD's portfolio continue to grow and increase their dividends, your income will grow as well. Over time, this steady investment, combined with the growth in dividends, can lead to significant wealth accumulation. The beauty of this strategy is that it accelerates the compounding process. Instead of spending your dividends, you're reinvesting them to buy more shares, which in turn generates even more dividends. Over time, this can lead to exponential growth in both your portfolio value and your income. Now let's take a look at the real potential of consistently investing $120 a week into SCHD and how it can completely transform your financial future. At first, $120 might not seem like a huge amount, but when you break it down, it's all about consistency. By investing $120 every week, you're setting yourself up for long-term success because those small contributions add up. Here's how. $120 a week multiplied by 52 weeks in a year totals $6,240 annually. Now, if you and John invest $120 per week in SCHD, here's what the future projections will look like. After 5 years, your portfolio will be valued at $40,136. In 10 years, it'll be valued at $114,969, while your investment at that point will stand at $62,400. This is the point when the gap between the amount invested and the ending portfolio value starts to increase significantly. After 20 years, your portfolio will be valued at $558,233. Give it 10 more years, and by the 30th year, by the time you retire, your portfolio will be valued around $2,628,133, with your total investment standing at approximately $187,200. What's interesting here is the dividend amount. By the 30th year, you and John will be paid $185,457 in annual dividends. So by the time you're retired, you're effectively receiving in dividends each year the same amount that you invested over the 30 years. This dividend amount equates to around $15,455 in monthly income, making it safe to say that $120 invested in SCHD is more than enough to surpass your full-time job income. Reaching retirement with this kind of income could effectively serve as your pension, offering you financial security without ever needing to worry about cutting back on your lifestyle. Want to know how the snowball effect works, turning $10,000 into a $9 million portfolio? Click the video on the screen.